Hello and welcome to the Denver Homes Market Report. This is your local Denver realtor and host of this show, Ricky.schoonover of Mode Denver Real Estate. Last month was our end of year special. I was a little late getting that one out. I had a bit of a cough, so it was difficult to read through my notes and actually get a show recorded without me taking a break in the middle to clear my throat. I don't edit this show, and the reason I don't edit this show is because I plan to take this show live. And so I want to practice it as if it is live. I've been doing this show well over 2 years now. And hopefully on my 3-year mark, when I start up season 3 here in April, my show from that point on will be a live recorded show. I've learned a lot over these last couple of years in doing this program. And that weekly show was just too much. And I took it from a weekly show into a monthly show. When I was doing it weekly, I just found myself rushing to get something pushed out rather than a well thought out show. So now it's a monthly update, and I'm actually getting more listeners now, and it's pretty easy for me to keep up with. So last month, being the end of month, we went over the numbers covering all of 2021 and how it compared to 2020. We also looked at December 2021 and what that might mean for the new year. The name of the game continues to be inventory, or lack thereof. And the tides are rising, and I'm not talking about climate change. I'm talking about the Feds, the 10-year Treasury bond, and yes, rate hikes are coming. The Feds freaked out the markets a bit last week, when they doubled down on their rate hike talks. Just a month ago, they were talking about a future meeting in March where a 25 basis point hike might be on the docket. Then 3 weeks later, they come out and say inflation is out of control and we are now putting a 50 basis point hike on the table. Well, of course, we were already feeling the squeeze, as investors were tightening up the bond market based on a 25 basis hike, and now that being doubled, the market took a pretty serious pullback. Things will even out over the next month or so as far as rates go. We'll have to watch and see what the Feds actually do in this upcoming meeting. However, this sparked an idea in my head. I have done these shows in the past. I think we all need to refresh ourselves. What does a rate hike mean in real dollars? So first and foremost, if you think rates are still at that 2.99 fixed for 30 years, just know that was a certain place in time last year that for now no longer exists. I recently had a buyer who is rock solid, and by rock solid I mean excellent credit scores, good income to debt ratios, long history of good credit, putting down 20% on the home. It doesn't get any better for a lender. She is considered very low risk in the realm of credit and mortgage lending. And the very best rate was still just above 3.75. So today, the best rate you can likely get on a 30-year mortgage is right around 3.75. So let's run some numbers. Let's first run numbers on a home purchase of, let's say, $625,000, 20% down, which equates to being $125,000. So that's going to leave us a loan amount of $500K. So $500,000 loan amount based on a 3.75 interest rate, you are looking at a principal and interest payment of about $2,315. Now, that very same $500K mortgage, but now at 4.25%, that payment goes to $2,460 per month. That's principal and interest. Now, the difference in that payment is only $144 a month, but that equates to $1,700 for the year. And if you kept that house for 30 years, well, you get the point. $144 per month is just pure extra money out the window by way of interest, giving it to your lender, and it all adds up. Oh, and just in case you're wondering, what is the real world total payment? With taxes and insurance and all that. So let's use the 3.75% since we're not at 4.25 yet. But I bet by the end of summer we'll be there, or maybe even higher than 4.25. We'll have to see. But let's assume today we are buying a home for $625,000. We're putting down that 20%. Our interest rate is locked in at 3.75%. So that gives us a P&I payment, the principal and interest, that I just mentioned, which was $2,315. Then we're going to talk about taxes. Those are about $225 a month, and insurance, which is about $205 per month. So when you add it all up, a $625,000 home with 20% down at 3.75% will run you a total of $2,745 per month. And that's if you take into account P&I along with the taxes and the insurance. And that's a pretty real world current scenario because it's pretty darn close to a deal I'm working on right now. And this is the best case, and I mean the best case. Solid home, great comps, solid buyer, local mortgage lender who knows the area. A $625,000 home overall monthly payment will run you $2,745 per month. Now, if you wait until after the rate hikes, past the summer, that payment very well could be pushing $2,900 or maybe even $3,000 per month. That's why I love this wise saying I heard from my good friend over at the Mortgage Network, Jaxanne Riggs. She says, Ricky, it's always better to buy real estate and wait rather than wait to buy real estate. And this is so true. And the reason it's true is due to the fact, real estate has a long history of being a very good investment. Much like a fine wine, an investment in real estate tends to get better with age. Sure, there are crashes and corrections and anomalies. The real estate market cycles like any other investment. But when you look at it from a 10-year span, even if you go back 100 years, but you look at a 10-year span, even through the Great Depression and the crash of 2008, 2010, if you're lucky enough to hold on to your property for a 10-year span, you're likely going to be okay. So you may be listening to today's podcast and you already own your own home and your rate is locked in. So why would a rate hike affect you as a homeowner? Well, if you're planning on selling in the near future, you will likely not get the prices that you have been seeing your neighbors getting over this past year. And the reason is just simple economics. See, when the rates are at or below 3%, that creates a huge pool of buyers who can all, afford to buy a home and get a mortgage loan. However, as the rates rise and you get above 4%, some of those buyers that were on the bubble will no longer qualify, and now they'll be out of the market due to sort of a combination 1-2 punch. That first punch, being that 16% increase in prices, which we had over this past year. That's crazy, right? 16% increase in average as far as the home prices go. And then there's a significant number of buyers who will no longer qualify for that loan now that it's at 4%, which they easily qualified at 3%. Once this happens, the next shoe to drop will be the leveling out of prices. Now, simply put, you may not see it as, you won't see those crazy bidding wars. And therefore, if your neighbor last year, they listed at $550, they got 6 offers in the first weekend, they sold it for over $600. This may or may not mean that you can now go and list your home for $600,000 and even, get an offer. In fact, you may find yourself having to list a little bit lower, maybe at the 5.75 mark, and then likely you'll get an offer, but you may not see the same feeding frenzy like when the rates were so low. So the moral of the story, if you're thinking about selling this year, list now before the rate hikes to avoid that uncertainty. Okay, well, we just closed out January 2022. Let's take a look at the numbers. Let's first see what the inventory was last February 1st, 2021, as it relates to this year, February 1st, and see where we were last year at this time and what we might expect for this year for February. So let's also look at how many homes we sold last year, January 2021, as that it compares to this year's January 2022. So first, February 1st, 2021, we had 13,400 homes listed for sale. This year, February 1st, 2022, we have just 5,589. So the inventory being so darn low compared to last year, the rate hikes may or may not really affect the home prices all that much. Only time will tell. Now, for the number of sales in January 2021, we sold a total of 5,700 homes. And then this past January 2022, we just passed by, we sold just shy of 5,000 homes. Now, obviously, we sold 700 less homes this year. However, I would not see that really as a slowdown as much as more of an inventory crisis. We really need sellers to pull the trigger and get in on the seller's market while it's still solid. Well, I hope you enjoyed today's podcast. I know it was a bunch of numbers, but very, very important you know this information, whether you're a buyer or a seller. These are all intertwined. And if you are a seller, I'd much rather buyers pay you as the seller top dollar for your home rather than you having to lower your offer price so they can afford the higher amounts of money to the banks by way of increased interest. This is Ricky Schoonover of Mode Denver Real Estate. Please visit my website, www.denverhomesmarket.com. Thank you for tuning in to this month's podcast, the Denver Homes Market Report. If you have an immediate question, please call or text me, 720-688-5110. I hope you have an awesome February.